Interested in investing in a business that is perfectly set up for a post-pandemic bounce? Looking for a dividend aristocrat that's offering a market-beating yield? Want to buy a high-quality dividend growth stock that's been beaten up and looks severely undervalued? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major provider of medical devices. Healthcare is ripe for long-term investment. Why? It's in secular growth mode. The global population is growing larger, older, and wealthier. What do you think more older people with more money are going to demand more of? Exactly. That's why this company has such a long runway for higher revenue and profit and bigger dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Medtronic PLC, which appear to be trading at a significant discount today. Medtronic PLC, stock ticker MDT, is a global developer and manufacturer of medical devices for chronic diseases. Founded in 1949, Medtronic is now a $111 billion by market cap healthcare giant that employs 95,000 people. The company reports results across 4 segments: cardiovascular, 37% of fiscal year 2023 revenue, neuroscience, 29%, medical surgical, 27%, and diabetes, 7%. Medtronic's product portfolio is comprised of a variety of life-saving and life-improving medical devices that include implantable defibrillators, heart valves, insulin pumps, glucose monitoring systems, pacemakers, stents, and surgical tools. Healthcare is fertile ground for long-term investors. See, demand for healthcare does not correlate with economic cycles. If one has a serious health issue, rectifying the issue is all that matters to that person at that point in time. The GDP or some other economic consideration is inconsequential. Well, to this point, health issues are a common feature of the human condition. Human bodies slowly deteriorate as they age. This means there's a constant base level of demand for healthcare through existence alone. Building on this, 3 demographic trends are combining to create secular growth across global healthcare. First, our global population is growing. Second, people are, on average, living longer than ever before. Third, the wealth of the average person continues to rise. A greater number of older and wealthier human beings walking around almost guarantees increased demand for quality healthcare. That's global healthcare in general, but Medtronic in particular is beneficially situated within the global healthcare complex. It comes down to the inelastic demand for its products. The spending on these products is usually non-discretionary in nature, especially if it's a life or death circumstance that does not lend itself to price sensitivity or negotiation. Let's say, for example, you need emergency surgery. One is much more concerned with survival than the exact pricing of the medical devices needed to save one's life. If all this weren't alluring enough, Medtronic also has market leadership in the areas in which it competes. Morningstar puts it like this, and I quote, "Medtronic has historically held roughly 50% share in its core heart devices. It's also the market leader in spinal products, insulin pumps, and neuromodulators for chronic pain, unquote. It's hard to imagine Medtronic not doing very well over the long run, which should translate to growth across its revenue, profit, and dividend. To date, the company has increased its dividend for 46 consecutive years. That's not only one of the longest dividend growth track records in healthcare, but in all of corporate America. It easily qualifies Medtronic for its status as an esteemed dividend aristocrat. The 10-year dividend growth rate of 10% is strong, although more recent dividend raises have been modest. Medtronic has been challenged over the last few years by the pandemic as elective procedures were delayed. This headwind has been dissipating, however, which sets up Medtronic for a big bounce in sales. Stock is offering a nice 3.2% yield while you wait for that to play out. Notably, that market-beating yield is 90 basis points higher than its own 5-year average. Despite that yield being so much higher than it usually is, the payout ratio is a reasonable 54.7% based on midpoint guidance for fiscal year 2024 adjusted EPS. I like dividend growth stocks in what I call the sweet spot. This yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. We're right in the sweet spot here. Looking at business growth, Medtronic moved its revenue from $17 billion in fiscal year 2014 to $31.3 billion in fiscal year 2023. That's a compound annual growth rate of 7%. I'm usually looking for a mid-single digit top-line growth rate from a mature business like this. Medtronic more than delivered. However, a major chunk of this revenue growth resulted from the acquisition of Covidien PLC in 2015 for almost $50 billion. This complementary addition to the company, with Covidien focusing on endomechanical instruments, adding to Medtronic's cardiovascular and orthopedic offerings, gave a large boost to the business in absolute terms. Relative profit growth on a per-share basis should better inform us. Earnings per share grew from $3.02 to $5.29 adjusted over this period, which is a compound annual growth rate of 6.4%. Even during a really tough period, which unfairly and inaccurately skews recent results downward, Medtronic still put up respectable numbers. This business could have done better if not for two serious headwinds, one of which is not the company's fault. First, Medtronic's outstanding share count has been increased significantly as a result of the company using equity to finance the Covidien acquisition. This has made growth on a per-share basis more onerous. Second, the pandemic has acutely affected Medtronic. The overwhelming focus on the pandemic by the global healthcare complex led to the delaying of anything that could be delayed, such as elective surgeries. Worse yet, key product launches coincided with the onset of the pandemic and lessened demand. In addition, the pandemic made it difficult to bring new supply to market. Put simply, Medtronic has been facing both supply and demand challenges over the last 3 years. But this coin has a flip side to it. Surgeries that could not be performed previously are almost certainly demand deferral, not demand destruction. These delays could be causing pent-up demand, which would be a strong driver of accelerated growth for the business over the next few years. Furthermore, the arrival of new products to the market precisely at the same time as rising demand could be a potent mix for the business, turning a former headwind into a new tailwind. Looking forward, CFRA believes that Medtronic will grow its earnings per share at a compound annual growth rate of 4% over the next 3 years. It appears to me that CFRA is forecasting a lingering hangover from the pandemic. Indeed, CFRA states, and I quote, "We see growth picking up to 5% in fiscal year 2025 with pandemic disruptions to supply and demand finally ending in our view," unquote. I think residual effects are still present, but will they last into fiscal year 2025? Hard to say. Either way, Medtronic is positioned really well for a full recovery. To that point, CFRA states, again, and I quote, "We expect strong results from Medtronic as its healthcare provider customers serve pent-up demand for procedures that had to be postponed due to the pandemic and then subsequent staffing shortages at medical facilities. Medtronic also stands out from medical device peers because of its product innovation and new launches, which drove market share gain during the pandemic and should continue to do so over the long term. One product line that has particularly immense potential is Medtronic's robotic-assisted surgery platform, which we see ultimately being adopted worldwide, up from 13 countries using the technology in fiscal year 2023. Unquote. The company's new robotic-assisted surgery offering, Hugo, which CFRA is referring to, is promising. If we move past the shaky near term, the long-term picture looks bright. Dividend raises over the next year or two are likely to be small, sure, but I see a good chance of Medtronic returning to its glory years after marching through this temporary setback. If the business can produce high single-digit dividend growth, which it seems fully capable of, that's a compelling offer on top of the 3% plus starting yield. Moving over to the balance sheet, Medtronic has a solid financial position that should improve as the business rebounds. The long-term debt-to-equity ratio is 0.5, while the interest coverage ratio is nearly 10. Profitability is good now, but I think this is another area of the business that can and likely will improve as the entire operating environment normalizes. Over the last 5 years, the firm has average annual net margin of 13.8% and annual return on equity of 8.2%. Medtronic was producing net margin closer to 16% before the pandemic hit, so there's a lot of room for margin expansion here. Medtronic has lost some of its luster, but it's in a great position to return to its former glory as supply and demand shocks fade. And with IP, R&D, switching costs, economies of scale, a global distribution network, high barriers to entry, and a diversified portfolio of entrenched products, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. All three of these risks are elevated for this business model in comparison to many other business models, in my view. Any changes in the way healthcare spending is managed, especially in the US, would almost certainly impact the company. Medtronic occasionally recalls products, which involves cost and reputation risks. Demand for medical devices is fairly disconnected from economic cycles, but a recession could cause people to delay or cancel elective surgeries. Any major technological changes in medical devices can alter the competitive landscape, which pressures Medtronic to constantly innovate and stay ahead of the tech curve. Every business has risks. Medtronic is no different, but I think the long-term reward picture here is compelling. Making that picture look even more compelling is the valuation, which appears to be quite attractive after the stock's 35% fall from its 2021 high. The price-earnings ratio is 16.6 using adjusted EPS. That's measurably lower than the broader market's earnings multiple. It's also favorable in comparison to the stock's 5-year average PE ratio of 34.4, but frequent adjustments make it impossible to accurately compare. A better comparison would be to look at the sales multiple, which doesn't suffer from the same adjustments. The current price-to-sales ratio of 3.8 is quite a bit lower than its own 5-year average of 4.5, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate looks conservative against the demonstrated dividend growth over the last decade, and it's also lower than the rate I've used in the past for Medtronic. I've become slightly less sanguine about the prospects due to the possibility of lasting scars on the business. Moreover, the earnings per share compound annual growth rate over the last decade is lower than this mark, and some of the prior dividend raises, which were sizable, came at the expense of expanding the payout ratio. Keep in mind, the most recent dividend raise was only 1.5%. Also, the near-term forecast for EPS growth is lackluster. Honestly, it's difficult to get a real handle on Medtronic. There are a lot of moving parts, and unprecedented hits to both supply and demand aren't helping. The last few years have been so tough, but I don't see why the business can't mount a serious comeback, even if it takes a few years to fully flesh it out. It's probably unreasonable to expect too much from Medtronic over the next 12 to 24 months, but I believe dividend growth could return in a big way when looking out past fiscal year 2025. I'm averaging things out here with a lot of the growth weighted out past the next year or two. The dividend discount model analysis gives me a fair value of $98.44. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates MDT is a 4-star stock with a fair value estimate of $112. CFRE rates MDT is a 4-star buy with a 12-month target price of $97. I came out very close to where CFRE is at, although we're all in a pretty close range. Averaging the three numbers out gives us a final valuation of $102.48, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. Medtronic PLC has been directly impacted by the pandemic, both in terms of supply and demand, but it's positioned well for an explosive rebound with a market-beating yield, a double-digit long-term dividend growth rate, a reasonable payout ratio, almost 50 consecutive years of dividend increases, and the potential that shares are 14% undervalued. Long-term dividend growth investors would be wise to take a good look at this Dividend Aristocrat right here, right now. And now for a special news announcement. Apple Inc., stock ticker AAPL, has done it yet again. The company announced the upcoming release of its all-new device called Vision Pro, which is its first foray into mixed reality. What's notable is that despite other players already in the market, Apple has leapfrogged them all with a device that is clearly heads and shoulders above the competition. It's more evidence that it's Apple's world and everyone else is just living in it. Apple remains one of my favorite long-term ideas for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.